Are you guys on target to make your debt reduction targets this year?
Yeah, very nicely on target. We started 2017 with $7.9 billion in total debt, and our target's to reduce that by $1.45 billion for the year, Danielle. And I'm happy to report that in the first half of the year, we reduced our total debt by just under $500 million. And then last week, we announced another $731 million of debt reduction. And so we're nicely on track for the 1.45 this year. On top of that, we intend to be to $5 billion in total debt by the end of next year.
And so for 2018, that was going to be my next question, whether or not you can meet next year's debt target, 1.45 million again, without selling anything.
Well, we'll see. I mean, I think that, Danielle, we started this debt reduction journey with $13 billion in total debt at the start of 2015. In 2015, we reduced that number by $3 billion. 2016, $2 billion. This year, 1.45. And we'll do it again, as we indicated this year, a combination of cash on the balance sheet, cash flow, and potential divestments if they make sense, but nothing unless we're getting full value.
All right, but let's pick up that divestment thread, because obviously, assuming that you would be selling a non-core asset, and correct me if I'm wrong about that, I guess the big copper asset would be 50% of Zaldivar. On the gold side, you've got 50% of Porgera. Which of those would be most likely to go?
I wouldn't handicap it. First of all, as we said throughout, no fire sales, and we're patient. As you see, we're managing the balance sheet very well. On top of strengthening the balance sheet, our liquidity continues to improve. Less than $200 million now due before 2020. We ended the second quarter with $2.9 billion of cash on the balance sheet. We have our $4 billion fully undrawn credit facility. So we're not forced to do anything. If the situation arose where there was a strong price for something, we'd consider it. But we don't feel the need to make any divestments. We'll wait and see. We're going to be patient.